In 2020, Elon Musk promised 1 million Tesla robotaxis on the road by the end of that year. Today there are about 20, and each one has a second car following it in case it fails. Yet Tesla is worth more than the next 9 car makers on Earth combined, priced at 400 times its earnings. Tonight, 5 of the greatest investors who ever lived score Tesla one by one. And they are about to disagree more violently than on any company we have ever tested. Not whether Tesla is a great company, whether at this price, it is a great investment.
5 legendary methods, 1 company, and the widest disagreement this board has ever recorded. The board convened in July 2026. These are the numbers the legends saw. This is not financial advice. It is a lesson in how the greats actually think. Both sides of this fight begin from the same balance sheet, so let's read it honestly. Tesla sells electric cars from factories that are themselves engineering landmarks on 4 continents. In 2025, Tesla delivered about 1.6 million cars. And for the first time in the company's history, that number went down roughly 9%. The first annual decline Tesla has ever reported. Revenue tells the same story. It slipped to about $95 billion, the first year Tesla's revenue has ever shrunk. But the top line is not the wound. The wound is the profit. Operating margin, which stood near 17% in 2022, fell below 5% in 2025. That is what a price war does to a car maker, even a great one. Net income dropped from more than $12 billion to under 4. Same company, same factories, roughly the same revenue, a third of the profit. And that profit leans on a crutch. Strip out regulatory credits, the money rival car makers pay Tesla for pollution allowances, and the honest margin on each car spend most of the year in the mid-teens. That credit stream, nearly $2 billion a year of almost pure profit, is now structurally collapsing as Washington guts the penalties that created it, down more than a third in a single quarter. There is one genuine bright spot, and it deserves its moment: energy storage. Giant grid batteries, and 2025 was a record year for them. 46 gigawatt-hours deployed at a gross margin near 30%, richer than the cars themselves. But the whole business is still only about 1/5 the size of autos, a promising second act, not yet the headline. Now the competitor the whole market watches, BYD. In 2025, the Chinese giant passed Tesla to become the world's largest seller of electric vehicles, over 2.2 million cars to Tesla's 1.6. BYD earns a healthy 20% margin on its cars and trades at about 22 times earnings. Toyota, which makes far more money than either, trades at roughly 9. Hold those two numbers, 22, 9. Because Tesla trades at about 400 times earnings, 16 times its sales. On the numbers a car maker is judged by, Tesla is priced at roughly 19 Toyotas. So the bulls give the only answer they can, then stop judging it as a car maker. The car business, the bulls say, is just the distribution network. The real product is autonomy, the software that will one day drive every mile, and the robots that will one day do every job. That is what 400 times earnings is actually buying. So test it against the street. Tesla's Robotaxi pilot runs about 20 supervised cars. Waymo, already driverless, completes roughly 250,000 paid rides every week. The gap between the story and the sidewalk is still enormous. And Optimus, the humanoid robot meant to be worth more than everything else combined. This year, the company itself admitted the robots are not yet doing useful work. The future may arrive. It has not arrived yet. Which is why Wall Street's price targets on this one company run from about $25 a share to over $2,600. 100-to-1 spread, the widest on any company its size in the world. And hanging over all of it, the promise that started this episode: 1 million robotaxis by the end of 2020. Full self-driving declared imminent every single year since 2015. The ledger of promises is long. The ledger of deliveries is short. Before the board convenes, check where the actual money stands. The founder personally bought $1 billion of stock. Short sellers have almost vanished. Barely 2% of the float bets against it. And it remains retail's most beloved holding on earth. The crowd is all in. Remember that. Every dollar of that 100-to-1 gap is one single question. Do you pay today in full for machines that do not yet earn a cent? 5 legendary methods are about to answer it, and they will not agree. Let's seat the board. 5 legendary frameworks reconstructed from their published methods, not the people, the methods. Each one scores Tesla from 0 to 10. The spread between them is tonight's real story. First to the bench, the Benjamin Graham model, the father of value investing. His rule was margin of safety: never pay a price where the arithmetic cannot protect you. His simplest test: flip the price-to-earnings ratio over and see what $1 of stock actually pays you. Tesla's earnings yield is roughly 0.25%. A 10-year government bond pays about 4.5%. The Graham method does not need a second data point. You are accepting 1/20th of the safe return for the privilege of owning all the risk. Book value offers no shelter either. The price is nearly 19 times the company's net worth, where this method wants 1.5. The single redeeming line is the balance sheet. Tesla is debt-free, with $29 billion in net cash. That is real. It is also the only thing here Graham would call safe. The Graham score, a 1. This, the method says, is not an investment operation. It is a speculation, wearing an investment's clothes. But the next chair will argue the arithmetic is measuring the wrong thing entirely. The Charlie Munger model. Munger paid up for great businesses, but demanded a durable moat, and above all, rationality. He hunted the gap between what management promises and what it delivers, and he despised hype. The engineering earns real respect. Tesla drove its cost per car from $84,000 to under $35,000. Half the industry said it could not be done. Tesla did it twice. And its charging plug became the American standard. Ford, GM, nearly every rival surrendered and adopted it. That is a genuine moat and a rare one. If the Munger method stopped here, this would be a high score. It does not stop here. Brand value fell 36% in a single year, the largest loss on the global list as the founder's politics bled into the showroom. 1 million robotaxis by 2020, robots doing useful work, admitted to be doing none. Munger's word for that pattern was always the same: hype. The Munger score, a 2, respect for the factory, refusal to pay for the fable. But is the market really pricing a fable or the future? The growth investor takes the chair. The Peter Lynch model. Lynch loved growth, but only at a reasonable price. His yardstick was the PEG ratio, the earnings multiple divided by the growth rate. Around 1 is fair. And his first job was always to classify the company before buying it. Here the method gets uncomfortable. Tesla's earnings fell 2 years running. You cannot compute an honest PEG on shrinking profits. On forward estimates, the number lands near 4. 4 times what Lynch called fair. And the classification fails. Deliveries dropped for 2 years, then jumped 25% in a single quarter as buyers rushed an expiring tax credit. That is the signature of a cyclical, a carmaker riding demand waves, not a smooth compounder you hold for a decade. Lynch's oldest warning fits exactly. Never invest in an idea you cannot draw with a crayon. A robotaxi network that does not exist yet cannot be drawn with a crayon. The Lynch score, a 3, growth, yes. at 4 times a reasonable price for a business he cannot cleanly classify. 3 chairs, 3 low marks. The scoreboard looks settled. It is about to break open. The Philip Fisher model. Fisher would hold a great growth company for decades, but he did his homework on the people, and he weighted one thing above almost everything: the ambition and integrity of management. On ambition, Tesla scores near the top of anything this board has seen. Research spending rose 41% in a year. Full self-driving crossed 10 billion cumulative miles, its improvement curve steepening. The energy business went from nothing to $13 billion. But Fisher's other test cuts the other way hard. The serial missed deadlines. A $1 trillion pay package. $2 billion of Tesla's cash rooted into the founder's private AI venture, then absorbed by his rocket company, leaving shareholders holding stock they never voted for. The Fisher score, a 5, the highest yet. Extraordinary innovation dragged back by a genuine governance hazard. The 2 nearly cancel. And now, the one investor on this board who does not care about value at all. The Stanley Druckenmiller model. Druckenmiller made his fortune reading the tape and the crowd, not the balance sheet. He would happily own an expensive stock if the narrative and the money flow were behind it, and he would sell it the instant they turned. This method ignores the 400 multiple that just crushed the value investors and asks a different question. Where is the crowd? Short interest sits near 2%. Almost nobody on earth is betting against this company. The crowd is long. The founder personally bought $1 billion of stock. The AI narrative is the most powerful story in markets, and Tesla is its purest physical world bet. Momentum, positioning, and story all point the same way, which is why this method scores it highest. But Druckenmiller's discipline is the catch. Sentiment this one-sided is not something you own. It is something you rent with your hand on the exit. You ride a narrative, you do not marry it. The Druckenmiller score, a 6, the highest on the board and the least loyal, a trade, not a marriage. 5 methods, 1, 2, 3, 5, 6. The composite board score, 3.4 out of 10. But the number that matters tonight is not the average. It is the spread, 5 full points from a 1 to a 6. This board has never disagreed this widely about a single company, and that disagreement is the real answer. Because every legend was reading the same balance sheet and scoring a different company. Graham and Munger scored a carmaker, priced insanely. Fisher scored a research empire, run by a man he could not fully trust. Druckenmiller scored a narrative and put his hand near the door. Tesla is the only mega company on Earth where the greatest investors alive cannot agree whether they are looking at a bubble or the future, because it is genuinely, measurably, both at once. Which one it becomes is the most expensive question in markets.
So here's what the board would actually tell you. If you need the arithmetic to protect you, Graham and Munger already answered, and the answer is no. If you're buying the robots and the robotaxis, understand you are paying in full today for machines that earn nothing yet, and betting the man selling them hits deadlines he has missed for a decade. And if you're trading the story, then trade it like Druckenmiller, rent it, and know where the door is. At these prices, the methods don't call Tesla a buy or a sell. They call it a mirror. It shows you exactly what kind of investor you are. These are AI models built from published principles, not the people, not their quotes, not endorsed, educational, not investment advice. Numbers as of July 2026, rerun the methods with today's. The board saw a 1 to a 6. What would it score today? Tell us below. And subscribe, because next the legends take the stand on the company the entire AI boom is built on.